Does your heart start pounding the week before a big earnings announcement? You know the feeling, that knot in your stomach when you're holding a position into the close just minutes before the numbers drop. It's that intoxicating, terrifying mix of gut-wrenching anxiety and lottery ticket hope. You refresh the page again and again, waiting for that first tick. Will it be a glorious 20% gap up or a soul-crushing plunge into the abyss? You've spent days, maybe weeks, preparing. You've read the analyst reports, you've listened to the conference call predictions. You've convinced yourself of a narrative. The new product is a game changer. There's no way they miss on subscribers. You've built the case so compelling in your own mind that it feels like a sure thing. And then, reality hits. The market doesn't care about your story. It doesn't care about how right you were on revenue. It cares about one sentence of forward guidance you overlooked, and suddenly your sure thing is vaporizing your account. The sleepless night that follows is filled with regret, self-blame, and the haunting question, what did I miss? I've been there. I remember my first few earnings seasons like they were yesterday. Glued to the screen, pupils dilated, heart hammering against my ribs, literally praying to the market gods for a green candle. I took massive, foolish risks. I celebrated wins like I was a genius, and agonized over losses like I was a failure. I lost money, but more importantly, I lost peace of mind. The stress was immense. It wasn't trading, it was high-stakes emotional gambling, and it was completely unsustainable. If any of that sounds familiar, I need you to listen closely. This isn't going to be another video about a guaranteed earnings strategy. Those don't exist. This is something far more valuable. This is a blueprint for your psychology. It's a guide to trading this chaotic period without losing your mind, without blowing up your account, and yes, without losing sleep. Before we dive in, I want you to do something for me. Go down to the comments right now and tell me, what's the one stock whose earnings report gives you the most anxiety? Is it a high-flying tech name? A volatile biotech? Let's get it out in the open. Acknowledging the fear is the first step to conquering it. Stick with me through this journey. We are going to completely reframe how you approach earnings season. We won't just talk about chart patterns, we're going to talk about your brain patterns. We'll start by dissecting why your brain is biologically wired to fail in this environment. Then, we'll build you an unbreakable pre-trade routine, a fortress, a process to protect you from your own worst impulses. From there, I'll show you how to trade the reaction, not the report, executing with clarity in the midst of chaos. We'll cover how to manage your sanity while a trade is active and the P&L is swinging wildly. And finally, we'll master the post-trade analysis that turns every single trade, win or lose, into a priceless lesson. By the end of this, you will have a step-by-step psychological playbook. You will trade from a position of strength, not fear. You will trade with a plan, not a prayer. Let's begin. Chapter 1. The Psychology of the Gamble. Why your brain is your biggest enemy. So we've acknowledged the feeling, the anxiety, the hope, the dread. But why does earnings season feel so much like standing at a roulette wheel? The answer isn't in the market, it's inside your own head. For generations, our brains evolved to survive in a world of scarcity and immediate threats, not to calmly interpret quarterly financial statements. And the cognitive wiring that kept us alive on the savannah is the very same wiring that makes us terrible earnings traders. To win this game, you first have to understand the opponent within. The first and most powerful psychological trap is what I call the lottery ticket effect. Your brain is not a statistician. It doesn't accurately weigh probability. Instead, it gets mesmerized by possibility. The small, remote chance of a massive, life-changing gain feels infinitely more compelling than the high probability of a small, manageable loss. Holding a stock through earnings isn't a calculated risk in your mind. It's a lottery ticket. You're not thinking about the 50-50 chance of a move against you. You're fantasizing about that 25% gap up that will make your month. This hope, this siren song of what if, overpowers logic and causes you to take risks that are mathematically insane. You're paying for a dream, and the market is more than happy to sell it to you. Next comes the master saboteur, confirmation bias. Once you have an idea, a thesis that a stock is going to soar or plummet, your brain goes on a mission. But it's not a mission for truth. It's a mission to prove yourself right. You will unconsciously seek out every piece of news, every analyst upgrade, every tweet that confirms your belief. Simultaneously, you will ignore, dismiss, or downplay any information that contradicts it. Saw a negative report from a credible source? They don't understand the company's moat. Did the CEO sound a little hesitant on that last interview? He's just being conservative. You build an echo chamber around your position until your belief feels like an undeniable fact. You aren't seeing the market. You're seeing a reflection of what you want to see. This flows directly into the narrative fallacy. Humans are storytellers. We make sense of the world by creating narratives. The brilliant new CEO is turning the ship around. This new technology is unstoppable. Their competitor is stumbling, so they must be gaining market share. These stories are powerful, compelling, and emotionally satisfying, and we fall in love with them. The problem is, we start trading the story instead of the reality of the price and the numbers. I once became absolutely convinced down to my bones, that a certain tech company was going to smash earnings. I loved their products. I read every glowing review. I built this perfect, heroic story in my head. The numbers were released, and they were fantastic. They beat on revenue, they beat on earnings per share. I felt a surge of validation. And then the stock tanked 15% in after hours. Why? Because their forward guidance for the next quarter was slightly weaker than expected. My beautiful story was worthless. The market didn't care about my narrative. It cared about the future. That was a painful, expensive, but vital lesson. You are not a movie director. You are a risk manager. Your job isn't to write the script. It's to react to the one the market gives you. And of course, we can't forget the monster that lives in the heart of every trader, FOMO, fear of missing out. There is almost no psychological pain more acute for a trader than seeing a stock you almost bought gap up 30% without you. That pain is so intense that it drives irrational behavior. You see a stock running hot into earnings, and FOMO screams, "You're missing it! Get in now before it's too late!" Or even worse, you see that post-earnings gap up, and FOMO convinces you to chase it, buying at the very top right as the early birds are taking their profits. FOMO turns you from a proactive planner into a reactive chaser. It ensures you buy high and sell low, the exact opposite of your goal. Think about your last big earnings loss. Be brutally honest with yourself. Was it the result of a calm, calculated plan with a defined risk, or were you buying a lottery ticket? Were you a victim of a story you told yourself? Were you chasing a move out of pure FOMO? Recognizing these biases is the first giant leap towards neutralizing them. You have to see the enemy to fight it. Your feelings of certainty, your gut feelings, your compelling stories during earnings season, these are not your allies. They are liabilities. The foundation of trading earnings without losing sleep is to accept this fundamental truth. Your default mental state is your biggest enemy. Now, let's build the fortress that will protect you from it. Chapter 2. The Fortress of Process. Your Pre-Earnings Battle Plan. Okay, so we've identified the enemy within. We know our brain is a mess of biases, telling us stories and selling us lottery tickets. So how do we fight back? We don't. We don't fight our emotions with willpower. That's a battle we'll eventually lose when we're tired or stressed. Instead, we make our emotions irrelevant. We do this by building a fortress of process, a rigid, systematic, non-negotiable battle plan that you create when you are calm and rational, long before the chaos of the earnings release begins. This plan becomes your boss. It tells you what to do, so your fearful, greedy brain doesn't have to. First things first, you must define your edge. Why are you even considering putting on this trade? Because I think it's going to go up is not an edge. That's a hope. An edge is a specific, repeatable reason. For example, historically, this stock has shown an implied volatility crush of over 50% post-earnings, so I have an edge in selling premium. Or, this stock tends to experience a multi-day drift in the direction of the initial earnings gap, so my edge is in waiting for the initial chaos to subside and trading that trend. Or even, the pre-earnings run-up has been excessively strong, far beyond historical norms. My edge is in betting that the news is already priced in and the stock will sell off regardless of the report, the buy the rumor, sell the news phenomenon. Without a clearly articulated edge, you are gambling. Write it down in a single sentence. If you can't, you don't have a trade. Once you have your edge, you build the core of your fortress, the if-then scenarios. This is the most crucial psychological armor you will ever build. Before the report, you will sit down with your chart and your notepad, and you will become a general planning for every possible outcome. You will write down, with specific price levels, exactly what your response will be. For example, if the stock gaps up above $150 and holds that level for the first 15 minutes of trading, then I will look to buy the first pullback to the 5-minute moving average with a stop loss at $148. If the stock gaps down to the key support level at $125 and immediately bounces, then I will wait for it to reclaim the pre-market low and take a long position, risking a drop back below $125. If the stock opens inside yesterday's range and does nothing, showing no clear direction, then I will cancel my orders and walk away. My thesis is invalid. You must map out the bull case, the bear case, and the dud case. Writing this down does something magical. It transfers the decision-making process from your future emotional self to your present rational self. When the stock is flying around and your heart is pounding, you don't have to think. You just have to read. You execute the plan. You obey the boss. Now let's talk about the fuel for this battle, your capital. And the rule is simple. Risk comes first, always. Before you even dream about the potential profit, you must calculate, down to the dollar, the absolute maximum you are willing to lose on this idea. This is your R, your unit of risk. Maybe it's 1% of your account, maybe it's 0.5%. Whatever it is non-negotiable. Your position size is then determined by this number. If your stop loss on a trade is $2 wide and your maximum risk R is $200, your position size is 100 shares. $200 divided by $2 equals 100. That's it. It's not based on how confident you feel. Confidence is not a variable in the equation. This single practice, sizing every position based on a predefined stop loss and a fixed risk amount, will save you from the catastrophic losses that haunt sleepless nights. Finally, you must choose your weapon. How you engage with the earnings event matters immensely. Holding through earnings. This is the highest risk, highest gamble approach. It's a binary bet. For most traders, especially those who want to sleep, I would strongly advise against this until you have years of experience and a deep understanding of options to hedge. Trading the pre-earnings run-up or sell-off. A valid strategy. You're trading the anticipation and hype, and your goal is to be flat before the report is released. This avoids the binary risk entirely. Trading the post-earnings reaction. This is where I believe the best psychological edge lies.
You let the gamblers and hopefuls do their thing. You let the dust settle. Then you come in and trade the resulting volatility and trend with a clear head and a solid plan. We'll dive deep into this in the next section. Using options. For more advanced traders, options are a phenomenal tool. A simple straddle or strangle allows you to bet on a big move without having to guess the direction. A credit spread allows you to sell the overpriced volatility with a precisely defined and limited risk. The psychological beauty of options is that your maximum loss is defined the moment you enter the trade. There are no surprises. I want to share something that changed the game for me. I started using a physical, laminated checklist, a literal piece of paper on my desk. Before any earnings trade, I had to tick the boxes. Is my edge defined in one sentence? Are my 3 if-then scenarios written down with price levels? Is my position size calculated based on my R? I could not press the buy or sell button until every single box was checked. It felt mechanical, even a bit silly at first. But what it did was build an unbreakable wall between my emotional impulses and the execution button. It forced process over passion. So you have your fortress, your edge is defined, your scenarios are mapped, your risk is controlled. The preparation is done. Now the earnings are out, the market is open, and chaos reigns. In the next section, we'll talk about how to open the gates of your fortress and ride into that battle with poise and precision.
Chapter 3. Trading the reaction, not the report. Executing in the chaos. The numbers are out. The headlines are flashing. XYZ Corp beats estimates. Or ABC Inc. misses. Shares tumble. Your gut reaction is to act on that headline, to buy the beat or short the miss. This is the single biggest execution error you can make. You must burn this into your mind. The numbers themselves are often a lie. A company can beat on revenue and earnings per share, and the stock can plummet. It can miss on both metrics, and the stock can soar. Why? Because the market is a forward-looking machine. The past quarter is history. What the market truly cares about is the future, the guidance, the outlook, the tone of the CEO on the conference call. These are the things that drive the institutional money that creates real, sustainable moves. Your job is not to be an accountant who is right about the past. Your job is to be a trader who is aligned with the market's interpretation of the future. And the only way to read that interpretation is through one thing and one thing only: price action. This leads us to the core of execution, the second move strategy. The initial knee-jerk reaction in the first 1 to 5 minutes after the market opens is pure, unadulterated chaos. It's driven by panicked retail traders, high-frequency algorithms, and emotional responses to headlines. It is often a trap. This first move is loud, violent, and unreliable. The professional trader watches this chaos with patience, letting the amateurs and algorithms fight it out. We are waiting for the second move. The second move is the one that begins after the initial frenzy dies down, typically 15 to 30 minutes into the session. This is when the bigger players, the institutions, have digested the report, listened to the conference call, and are beginning to strategically position their massive orders. This move is often calmer, more deliberate, and more likely to represent the true trend for the day or even the next several days. Your patience in waiting for this second move to emerge is your primary competitive advantage. So while you're waiting, what are you looking at? You're looking at your lifelines, key technical levels. In an environment of extreme emotion, objective levels on a chart are your anchors to reality. Before the market even opens, you should have these marked: the pre-market high and low, the previous day's high and low, major daily or weekly support and resistance levels, key moving averages like the 50 or 200 day. These are not arbitrary lines. They are areas where a battle between buyers and sellers is likely to occur. A stock that gaps up and then fails at the pre-market high is telling you a very different story than one that slices through it like it's not even there.
A stock that gaps down and finds a wall of buyers at the 200-day moving average is giving you a crucial piece of information. These levels are where you look for confirmation of your if-then scenarios. You don't just blindly buy a gap up, you wait to see if it can hold above a key level, confirming institutional support. This brings us to two classic patterns you'll see over and over: the gap and go versus the gap and crap. A gap and go is a powerful trending move. The stock gaps up or down, and after a brief pause or a small initial pullback, it continues moving strongly in the direction of the gap for the rest of the session. The key signal is its behavior at the open. It will typically open, establish a clear opening range in the first 5 to 15 minutes, and then break out of that range with conviction. This is your signal that the second move is beginning. A gap and crap, or a gap and rip for a down gap, is a reversal. The stock makes a big gap in one direction, but immediately faces opposing pressure. For a gap up, it might fail to make a new high after the first 5 minutes, and then start breaking down below the opening price. This is a classic fade setup. The initial emotional pop has exhausted itself, and now the sellers are in control. I will never forget an early painful lesson in this. A well-known software company gapped down hard, maybe 20% on an earnings miss. I saw the red, and my greedy brain screamed, "This thing is going to zero!" I jumped in and shorted it right at the opening bell, thinking I was a genius. The initial panic did push it a little lower for about 3 minutes, but then it found its footing right at a major weekly support level I hadn't bothered to mark. Buyers stepped in, the panic subsided, and the stock began a slow, grinding reversal. I was squeezed into oblivion, taking a massive loss on a trade I was so sure of. What did I do wrong? I traded the headline. I traded the first move. I didn't wait for confirmation. I didn't respect key levels. The professionals were waiting for that bounce off support. I was the amateur, providing them with liquidity. That loss taught me, let the market show its hand first. Patience is not passive, it is a strategic weapon. During this entire process, you must be practicing real-time emotional regulation. When the P&L is swinging by hundreds or thousands of dollars every few seconds, your body goes into fight or flight mode. Your heart rate increases, your breathing becomes shallow, your focus narrows. You need to consciously break this cycle. Take a deep box breathing, in for 4 seconds, hold for 4 seconds, out for 4 seconds, hold for 4 seconds. If you feel overwhelmed, physically stand up and step away from the screen for 60 seconds. Walk around the room. Drink a glass of water. Remind yourself, my plan is my boss. I am just the employee here to execute. You must cling to the objective logic of your if-then plan because your emotions will be lying to you every second.
Chapter 4. The Art of In-Trade Management. Staying sane while the P&L swings. You've done the prep work. You've waited patiently. You've executed your entry based on a clear signal. Now you're in the trade. For many, this is where the real psychological battle begins. The stock is moving, and the little green and red numbers of your profit and loss are dancing on the screen. This is the moment when discipline is forged or broken. How you manage yourself in your trade from this point forward will determine not only your profitability, but your sanity. The first and most important rule of in-trade management is this: your P&L is not your scorecard. It is a distraction. I want you to repeat that. Staring at your fluctuating P&L is psychological poison. When it's green, it triggers greed. Look how much I'm making. I should add more. It's going to the moon. When it's red, it triggers fear and hope's evil twin, despair. I can't take this loss. I'll just hold on. Maybe it'll come back. I'll give it a little more room. Both of these emotional responses will lead you to deviate from your plan and make catastrophic mistakes. So what do you focus on instead? You focus on the price action in relation to your plan.
Is the stock still behaving the way your thesis said it should? Is it holding above the key level you identified? Is it still trending above the 9-period moving average you're using to trail your position? Your job is to manage the trade based on the chart, not based on the money. Some trading platforms even allow you to hide your P&L. If yours does, I highly recommend using it during these volatile trades. Detach from the outcome, attach to the process. This brings us to the ultimate test of discipline. You must treat your plan as your boss, not your feelings. Your heart will scream at you. If the trade is a winner, it will scream, "Take the money and run before it disappears." This causes you to cut your winners incredibly short, violating the primary rule of trading: cut losers short and let winners run. If the trade is a loser, your ego will scream, "You can't be wrong, it will come back." This causes you to hold on to losing trades long past your stop loss, allowing a small, managed loss to metastasize into a devastating blow to your account. You have to understand, the version of you that wrote the plan, calm, rational, and objective, is a genius. The version of you staring at the flashing screen, emotional, anxious, and high on adrenaline, is an idiot. You must empower the genius and muzzle the idiot. The written plan is your tether to rationality. Obey it no matter how much it hurts in the moment. One of the most powerful psychological tools to help you do this is scaling in and scaling out. You don't have to be binary, 100% in or 100% out. Let's say your plan has 2 profit targets. When the stock hits profit target 1, you sell a portion of your position, maybe a third or a half. This does several incredible things for your psychology. First, you have instantly paid yourself and locked in a realized gain. The trade is now a winner no matter what happens next. Second, you have reduced your risk. Your remaining position is smaller. Third, and most importantly, it frees you up mentally. With profit in the bank, you can now manage the rest of the position with far less emotion, allowing you to patiently hold on for that bigger move to profit target 2. It's the perfect blend of securing gains and allowing for greater potential. Finally, we need to talk about the stop loss. There is a right way and a wrong way to move your stop loss. The only reason to ever move your stop loss is to lock in profit. This is called a trailing stop. For example, once the stock hits your first profit target and you've scaled out on the remaining position, you can move your stop loss on the remaining position to your original entry price. Now you have a risk-free trade. It's impossible to lose money. From there, you can trail it up under key levels or moving averages as the stock continues to move in your favor. The cardinal sin, the one that blows up more accounts than anything else, is moving your stop loss to give a losing trade more room to breathe. This is not a strategy, it is a prayer. It is you telling the market, "My plan was wrong, my analysis was wrong, but my ego can't handle being stopped out, so I'm going to abandon all discipline and hope I get lucky." Hope is not a trading plan. The moment your trade hits its predefined invalidation level, your stop loss, the thesis is dead. You execute the stop, take the small planned loss, and live to fight another day. Protecting your capital is your #1 job. Honoring your stop loss is how you do it. I remember holding a winning trade on a big-name retailer after a positive earnings report. It screamed up and hit my first profit target. My plan, written in black ink, said, "Sell half." But my greedy brain was screaming, "No, this is the one! It's going to double from here!" It was a real battle. I forced myself, heart pounding, to follow the plan and sell half. The stock kept running another 3%. The feeling was awful. "You idiot," my brain taunted me. "You left so much money on the table." But later that afternoon, some broader market news hit, and the stock reversed hard. It came all the way back down and stopped me out on the second half of my position for a small gain. Had I held the full position, my fantastic winning trade would have turned into a break-even or even a loss. That day, following the plan when it felt wrong was the most profitable decision I could have made. That is the essence of in-trade management.
Chapter 5. The Post-Mortem. Forging experience into wisdom. The trade is over. The dust has settled. Your P&L for the day is final. What's the natural human tendency? If it was a winning trade, you feel like a genius. You puff out your chest, maybe take a screenshot, and you want to ride that dopamine high. If it was a losing trade, you feel like a fool. You want to slam your laptop shut, walk away, and forget the entire painful experience as quickly as possible. Both of these reactions are wrong. Both of them rob you of the single most valuable asset you can gain from any trade, the lesson. The final, most critical, and most frequently skipped step in trading earnings without losing sleep is the post-mortem review. This is where you transform raw, chaotic experience into structured, actionable wisdom. This is the step that separates the amateurs who repeat the same mistakes forever from the professionals who consistently grow and adapt. And the number one rule is this: win or lose, you review. The outcome of the trade, the profit or the loss, is the least important piece of data. I want you to let that sink in. A profitable trade where you broke all your rules is a bad trade. You got lucky and you reinforced bad habits that will eventually destroy you. A losing trade where you followed your plan to the letter, perfect entry, respected stop loss, excellent execution, is a good trade. You executed your process flawlessly, and the setup just didn't work out. That is a normal, acceptable part of the business. Your review should not be about judging the outcome. It should be about grading your adherence to the process. To do this, you need a trading journal as your therapist. And I don't just mean a spreadsheet with entry and exit prices. That's bookkeeping. I mean a real journal where you dissect the anatomy of the trade and, more importantly, the anatomy of your own mind. Within 24 hours of the trade, while the feelings are still fresh, you need to sit down and answer a series of hard questions. Be brutally honest. The plan. Did I have a written plan with a clear edge and if-then scenarios before the trade? Or did I improvise on the fly? The entry. Did I enter based on the predefined signal in my plan, or did I chase a move out of FOMO? Was my entry patient or impulsive? The risk. Did I use the correct position size based on my predefined $R risk? Or did I bet big because I felt confident? Did I honor my initial stop loss, or did I move it out of hope? The management. Did I manage the trade based on price action and my plan, or was I staring at my P&L? Did I take profits at my targets? Did I let the trade stop me out when it was invalidated? The psychology. This is the most important part. Write down how you felt. When did you feel fear? When did you feel greed? What was the trigger? Was it a sudden price spike? Was it seeing the P&L number jump? Connect your emotions to your actions. For example, I felt intense anxiety when the stock pulled back 50 cents, so I exited the trade even though it never hit my stop loss or violated the trend. This caused me to miss the larger move. For years, I avoided my journal after a big loss. It just felt like rubbing salt in a wound. The single greatest catalyst in my trading career was the day I made a new rule. I had to review my worst losses first, in excruciating detail. It was painful, but as I did it, I started to see the same ugly patterns over and over again. I saw that 90% of my biggest losses came when I ignored my stop loss. I saw that I consistently bought stocks that were already up 15% on the day, chasing out of pure FOMO. Seeing it there, in my own handwriting, trade after trade, was the cold hard evidence I needed to finally break the cycle. My journal didn't just record my trades, it rebuilt my trading brain. This process, plan, execute, review,
creates the feedback loop of mastery. Each cycle, each trade provides data, not just market data, but data about you. You find your unique weaknesses. Maybe you're great at finding entries but terrible at holding winners. Maybe you're disciplined with stops but tend to oversize your positions. This review process illuminates these flaws so you can systematically address them. This is how you stop making the same expensive mistakes. This is how you compound your wisdom, not just your capital. And this, ultimately, is how you build the unshakable confidence that allows you to trade with peace of mind, knowing that win or lose, you are growing, you are learning, and you are in control of the one thing you can control: yourself.
Conclusion. We've been on quite a journey. We started with that familiar, gut-wrenching feeling of anxiety that earnings season brings. We looked it square in the eye, and we didn't flinch. We've dissected it, understood it, and laid out a comprehensive battle plan to conquer it. We began by confronting the hard truth in Section 1. Our brains, with their love for lottery tickets, compelling stories, and confirmation bias, are fundamentally not wired for this environment. Acknowledging that your mind is your biggest enemy isn't pessimistic, it's the first strategic step toward victory. Then, in Section 2, we built our fortress. We replaced vague hopes with a concrete process. We learned to define our edge, to map out every possibility with if-then scenarios, to put risk management before the dream of profit, and to choose our weapon wisely. This fortress of process is what shields you from the emotional storm. In Section 3, we rode into battle, not by gambling on the report, but by trading the market's reaction. We learned the power of patience, of waiting for the second move, of using key levels as our anchors in the chaos. We learned to trade what we see, not what we think. Section 4 was the crucible of in-trade management. We learned to ignore the siren song of the P&L, to obey our written plan like it was our boss, to use scaling as a psychological tool, and to treat our stop-loss as a sacred contract with ourselves. This is where discipline is truly tested and forged. And finally, in Section 5, we closed the loop. We transformed every trade, win or lose, into a priceless asset through the Post-Mortem review. We learned that the secret to long-term success isn't in never losing. It's in never wasting a lesson. This feedback loop is the engine of mastery. So what's the secret to trading earnings season without sleeping at night? It's not a secret indicator. It's not a magic formula you buy online. It is the boring, unsexy, but profoundly powerful work of mastering yourself. It's about methodically replacing gambling with process. It's about replacing hope with strategy. It's about replacing anxiety with the calm acceptance that you cannot control the market, but you can, with absolute certainty, control your actions. You now have the blueprint. The path is laid out before you. I won't lie to you, it won't be easy. Your old habits will fight back. You will still have losing trades, but they will be different now. They will be good losses, controlled, planned, and understood. They will be the small tuition payments you make to the market in exchange for invaluable experience, not the catastrophic emotional blow-ups that steal your capital and your peace. So I ask you again, as you head into this next earnings season, as you see that volatile stock on your watch list getting ready to report, are you going to gamble or are you going to trade? Are you going to be a victim of your emotions, or are you going to be the commander of your process? Are you going to lose sleep, or are you going to execute your plan? The choice, as always, is yours. Use this blueprint. Start small. Focus on flawless execution, not on the profits. Begin the journey of becoming the trader who can navigate any storm, not with arrogance, but with a quiet, unshakable confidence. Trade smart, trade with a plan, and get some rest. You've earned it.